I know that fund. I've known it since Nicole Connolly started it, and I like it. I think it's good. The money goes into, when I last looked, it was going into Utilities Trust of Australia, which is run by Westpac, and also Palisades. Is that the one? But mainly UTA. And UTA's long-term return from infrastructure has been in the order of 11%. And so I think, Infrastructure Partners is charging their own fee, which I think is possibly 0.8. So that comes off it. But there's no other retail access available. I mean, it's very hard to get retail access to unlisted infrastructure, and Nicole's thing, IPIF, is one of the few ways to do it. We've got at InvestSMART, we've got some infrastructure. We've got an infrastructure fund, which is an ETF-based fund. And the good thing about that is the fees are very low. In fact, they're capped, like all of the InvestSMART ETF products. It's capped, but it's basically listed. This is not that, so it's not unlisted. But the Infrastructure Partners is a good thing. What they do is they collect up the money and they invest it every now and again into, well, I think when they get to 30 million or something like that, they put it into UTA. I look. The thing about all unlisted investments, unlisted infrastructure included, is you have to be aware that it's not liquid. You know, you're not going to be able to sell it immediately. It takes a bit of getting out of. So if you're okay with that, and you're not putting too much of your portfolio in it, and that you're maintaining some liquidity that is able to, give you access to money when you need it, then it's fine. I think unlisted infrastructure is a good option. The other thing to bear in mind, though, just while I'm on the subject, is the valuation of unlisted infrastructure is based on interest rates rather than the daily kind of demand and supply in a market. And so the valuers come in and they'll value the airport or toll road or whatever it is based on a discounted cash flow of future cash flows, a net present value of future cash flows, and that is very highly correlated to the discount rate, which is generally the bond rate, and bond rates are low. And part of the reason, in fact, if not the main reason, that infrastructure investments have done well over the last few years is because that bond rate has come down. That means the discount rate has come down, which means that the net present value of future cash flows has increased. At some point, bond rates are going to go up. When will that be? It could be tomorrow. Who knows? I'm just saying that at some point, bond rates go up, and that will lead to a headwind for the valuations of infrastructure investments. On the other hand, the reason bond rates go up is because the economy is growing and inflation is growing, and therefore it's possible, likely, that the income, the revenue of these infrastructure investments, such as airports and so on, will also increase. And so there's an offsetting of the increase in the interest rates, which lowers the net present value of future cash flows, but the future cash flows are increasing potentially because the economy is growing.